Tonight, we bring you a comprehensive look at significant developments across global commodity markets, escalating geopolitical tensions in the Middle East, and critical shifts in the structure of silver and gold markets, all of which are unfolding simultaneously as a new trading week approaches. Silver closed at $84 in Western markets on Friday. Meanwhile, Shanghai is currently pricing the same metal at $96, representing a 14.5% premium for Eastern physical silver over Western paper contracts. This gap has been expanding consistently across recent trading sessions. The sequence of premiums recorded over that period reads as follows: 13.5%, 13.8%, 13.7%, 14.5%, 14%, and now 14.6%. Market analysts note this is not random fluctuation. It reflects a clear directional trend indicating where demand for physical metal is currently concentrated. Adding further weight to this dynamic, professional buyers have been withdrawing physical silver from the COMEX exchange every single trading day. Institutional participants consistently taking delivery of real metal, session after session. At the same time, the Sprott Physical Silver Trust is trading at a 5.7% discount, indicating that Western retail investors have not returned to the silver market in any meaningful way. For context, in the year 2011, the Sprott Trust carried an average premium of 17.3% across the full calendar year. The contrast between that historical benchmark and today's 6% discount signals that the current move in silver is not being driven by Western speculative sentiment. That distinction carries significant implications for how this market is being read by institutional participants. When Western retail does re-engage, the shift from discount to premium represents an additional layer of return beyond the physical price movement itself. Turning now to the geopolitical developments that are reshaping global energy markets, the situation in the Middle East has intensified considerably over the weekend, building on an already volatile foundation established through the previous week. To recap the conditions entering this weekend, West Texas Intermediate crude oil posted its largest weekly gain since 1983. The Strait of Hormuz was functionally closed to Western-linked vessels, and over $900 billion was wiped from United States equity markets in a single trading session. Since those developments, the situation has escalated further on multiple fronts. Iran struck a multi-flag tanker near the Strait of Hormuz. The United States military is now preparing to deploy a third aircraft carrier to the Middle East region. One carrier represents a presence. 2 constitutes a warning. 3 signals a materially different operational posture. Israeli forces completed extensive overnight strikes across Tehran and against military infrastructure at Mehrabad Airport. The United States struck a freshwater desalination facility on Keshem Island, a notable escalation in terms of target type. Iran's foreign minister has issued warnings of consequences in response. A United States assessment concluded that even a large-scale military campaign would be unlikely to fully remove the Iranian government. That assessment, originating from within the U.S. intelligence apparatus, indicates there is no clean or near-term resolution currently being anticipated. Statements from Iran's president suggesting attacks against neighboring countries would cease have been characterized by some observers as a peace signal. However, a careful reading of the actual language reveals that Iran is addressing its neighbors, not the United States or Israel. That framing is consistent with an effort to create distance between Gulf states and the Western coalition, rather than a genuine offer to stand down. Strikes have continued, and new targets are under consideration. Oil crossed $100 per barrel this weekend, with Oman crude confirming above that level first. Oman crude serves as the primary pricing reference for Middle Eastern oil flowing into Asian markets, making that benchmark particularly significant. That level has not yet been reached across all benchmarks, but Oman crude leading above $100 is the signal markets are now watching closely. We turn now to the energy supply picture, where additional developments are compounding an already strained global market. Qatar has declared force majeure on liquefied natural gas exports following the shutdown of the Ras Laffan facility, one of the largest LNG production complexes in the world. Qatar supplies approximately 20% of global LNG, and the timeline for returning to normal output is estimated at 1 month or more. This constitutes a structural supply disruption to a market already operating under significant stress. A publicly stated objective from the head of the United States National Energy Dominance Council added further context to the strategic picture. The official stated that the United States will ultimately not need to be concerned about the Strait of Hormuz, as the goal is to remove oil entirely from the control of those currently holding it. That language does not suggest a short-term disruption timeline. Europe faces significant exposure within this environment. Prior to the conflict in Ukraine, European nations relied heavily on low-cost Russian pipeline gas. That supply is no longer available. The replacement, expensive liquefied natural gas, is now under pressure from multiple directions. Russia is redirecting its remaining LNG flows to China and India ahead of the European Union ban taking effect. Qatar's facility is offline, and the Hormuz corridor remains restricted. European natural gas prices have already risen more than 50%. The United States currently supplies more than half of Europe's liquefied natural gas, meaning Washington effectively holds considerable influence over European industrial energy costs. If the current disruption extends over weeks, the consequences move beyond price increases into questions of sustained industrial capacity. Economist James Rickards outlined the structural mechanics of this type of scenario in his work on currency dynamics. Specifically, how energy price shocks driven by supply disruption create inflationary pressure that conventional monetary policy cannot effectively address. Raising interest rates in response to a supply-driven price shock risks economic contraction without resolving the underlying price pressure. That is the dilemma now facing the Federal Reserve in light of the oil price movements reported over recent days. In that kind of environment, physical assets with constrained supply have historically repriced upward over time. A broader framework circulating in macroeconomic analysis circles also deserves examination on its factual merits. The argument holds that conflicts near major energy choke points function as a form of global cost increase. Rising oil prices elevate the cost of transportation, agriculture, shipping, manufacturing, and logistics across the global economy. Because oil is priced in United States dollars, every nation requiring energy must first acquire dollars to purchase it. That sustained international demand for dollars is a structural feature of the current global system. Energy demand in this framing becomes dollar demand. Revenues concentrate among a relatively small group of energy producers, and a significant portion of that capital has historically recycled back into United States government debt markets. Turning now to the gold market and central bank activity, the People's Bank of China increased its gold holdings in February for the 16th consecutive month. 30,000 troy ounces were added, bringing total holdings to 74.22 million fine troy ounces. The World Gold Council noted that global central bank gold buying slowed broadly at the start of the year, with net purchases totaling 5 tons in January, against a 12-month average of 27 tons. China's purchases did not slow during that period. Gold is currently trading above $5,170 in Western markets. Poland's central bank governor has proposed selling gold reserves to fund defense spending, though overall global buying continues to outpace selling. The concentration of buyers remains in Central and East Asia, a geography that connects directly to the expanding Eastern silver premium discussed earlier. On the subject of silver market structure, a significant shift has emerged in futures positioning that has received minimal coverage in mainstream financial media. For the first time in decades, silver is no longer the number one commodity by days to cover on the concentrated short position chart. Platinum has taken that position. The reason is that the 8 largest commercial traders in silver have been aggressively covering short positions over the past 6 months. The 4 largest traders still hold a significant short position, which appears concentrated within just 2 United States banks. However, traders ranked 5 through 8, the smaller commercial participants, now hold their smallest short positions on record. The commercial traders who have historically represented the most consistent source of selling pressure in silver futures are reducing their exposure at a pace and scale that represents a meaningful structural shift. The Commitment of Traders Report, a public weekly document, reflects this trend and is available for independent verification. The COMEX leverage ratio currently sits near 7 paper ounces for every registered physical ounce available for delivery, a ratio that has historically preceded significant price adjustments in physical markets when resolution occurs. As we conclude tonight's report, it is important to note that tokenized gold products, including Pax Gold and Kinesis, continue trading through the weekend. These instruments do not close when traditional markets do, and as of the time of this broadcast, they are trading close to Friday's closing levels, with no significant movement in either direction. COMEX registered inventory levels and Shanghai silver premium data remain key indicators to monitor as markets prepare to reopen. The Commitment of Traders Report, PBOC purchase figures, and COMEX inventory reports are all publicly available documents that can be independently verified through official sources. To summarize the key developments covered in this report, silver is carrying a 14.6% Eastern premium over Western paper pricing, with institutional buyers consistently withdrawing physical metal from COMEX, while the Sprott Physical Silver Trust trades at a discount. Geopolitical tensions in the Middle East have escalated across multiple fronts, with a third U.S. aircraft carrier being deployed, continued strikes on Iranian infrastructure, and Iran striking a tanker near the Strait of Hormuz. Oil has crossed $100 per barrel on the Oman crude benchmark. Qatar has declared force majeure on LNG exports from one of the world's largest production facilities. China's central bank extended its gold purchasing streak to 16 consecutive months. And for the first time in decades, silver has relinquished its position as the commodity with the largest concentrated short position, as commercial traders have reduced exposure to the smallest levels on record. All data and figures cited in this report are drawn from publicly available sources, including official central bank disclosures, the Commitment of Traders report, and exchange inventory records. This has been your market and geopolitical update. Good night.